President, IMC Chamber of Commerce and Industry, to present the welcome address. Over to you, sir.
Good afternoon, ladies and gentlemen. Welcome to the last session of this conference. It's been a very, very fruitful conference. I really appreciate the hard work done by Mr. Sridhar and the BFSI team who put together such a wonderful event where every speaker was brilliant. Lots of great insights have been given, and there's a lot of takeaways for each one who attended this conference. It is not always that it happens. So that's great. I apologize for not being here in the morning session to welcome you because I had some personal difficulties. But I'm happy that I'm here at least now to talk to you. This is the last session of this conference in this hall. But I don't want this conference to get over here, and I want it to continue in your mind. And I'd like you to debate some of the important issues that you have heard about today, because there are a lot of unresolved issues. And if these issues can't get resolved because of your application of mine, it will be great for the banking system, it will be great for the country. I will just talk about two things. One is this $10 trillion economy and the implication on banking. And the other, because the GDP has its own implications, and I'll bring some interesting viewpoints on that. And then I will talk about how a huge revolution in banking is going to happen. No one's talking about it. And it's going to hit us very soon. And you might as well think about it now and realize it's going to happen. I know many bankers are aware of it, but we haven't discussed it today. So let me start with whether or not we're going to be a $10 trillion economy or a $5 trillion economy. There's a debate going on outside this hall. No, it really doesn't matter. See, for instance, whether it's between 5 and 10, it doesn't matter. It's going to be in that range. What does it take for us to become a $6 trillion economy, starting from where we are today? The economy has to grow at a nominal rate of 10% per annum, compound. If you take out the 3 or 4% per annum inflation, really talking about 6 to 7% real GDP growth continuously for the next 5-6 years, or for nearly 9 or 10 or 11 years. Highly doable. So what does it mean for us is what I want to explain. Just think about 6 or 7%, let's say 6.5%. What can 6.5% do for us as India? Just think of India as India 1 and India 2. India 1 being all of us who can lead a decent life, and India 2 being those who are not able to afford a decent life. Back in 2005, almost 7% of the families in India, or the 7% of the households in India were in India 1. And they accounted for about 29% of the disposable income. So we are a poor country, albeit a developing economy. I'm talking 2005, not long ago. But if we grew, and we have grown at about 6.5% since then, and we, as I just mentioned, it's not a big deal to grow up to 2030 at that rate. You know what will be the situation in 2025? Take a guess. This 7%, India 1 accounting for 7% of families in India, it will become 49% of the families in India, 49% households in India will be in India 1, up from 7%. And this 49% will represent 82% of the buying power of this country, the disposable income of the country, up from 29%. Just imagine what it will do for manufacturers of goods and services, marketers of goods and services, and more importantly for banks, because you're the ones who are going to grease the movement of goods and the flow of goods and services. So the opportunity is huge. But today we have debated the role that you'll have to play in order to enjoy that benefit. All the work you've done as bankers to create new accounts, to help inclusive banking, etc., will pay off very fast. When in 2025, it's not far away. So the returns will be great for the kind of effort you're putting in today, because a large number of families are migrating from India 2 to India 1. India 1 will be growing at 11% or more, not 6 or 7%. It's only when India 1 grows at 7 or 11 plus percent that the average of India 1 plus 2 will be about 6.5%. So imagine which country in the world can afford bankers and manufacturers and marketers of products and services such a lovely market in the future. Okay? But let me now come back to the second thing, which I said I will talk about. It's a fundamental aspect which is going to change, which is ripe for big change. And as I mentioned a little while ago, not being talked about. I'm sure the banking system has become very, very heavily regulated, very competitive, very tough to make money in banking. Many senior bankers will agree. It is not like it was 10 years ago. I'm sure they will implement all the kinds of digital technologies which will help them to acquire customers faster, serve customers better, serve customers at cheaper costs, etc. But that is given. If you think that anywhere and anytime banking is a huge paradigm shift, think about what's going to come. You haven't seen it all yet. We have discussed cyber risk. We discussed competition from fintech companies today, and the new types of demand from manufacturing companies that will emerge into the fourth industrial revolution, where cyber systems will overlay the manufacturing system and create a totally interlinked value chain or supply chain, and banks will have to fit into it. Even there's work going on. But one place where I see a dead silence is the new kind of money that's going to come in. I'm not talking about cryptocurrencies. The biggest challenge to the banking system is going to come when digital fiat currencies are introduced. When I say digital fiat currencies, it will be legitimate currencies issued by the sovereigns through their central banks. So they are called CBDC, that is central bank digital currencies. These are going to happen before 2030, most probably around 2025. Are we ready for it? I think not. So I'd like to spend a few minutes on that without giving a lecture on CBDC. There are nearly 40 central banks around the world which are already trialing these things, doing various kinds of tests, but they're not ready for the market because technology has not fully been licked. It's only just give them a little time, it'll happen. Even our Reserve Bank of India, I understand, is thinking about these things. I don't know how much has been done. But even in India, before we reach 2030, we will have central bank digital currencies, which will run in parallel with our paper currency. Why will this happen? Because there's a lot of pressure on central banks to come up with CBDC so as to counter the impact of cryptocurrencies. After all, who are the people who are investing in cryptocurrencies? Very brave people. When I say brave, I also mean speculators. Then there are people who are in the cryptocurrency mining business as entrepreneurs. Of course, some digital nerds and money launderers. No country can afford to have private money system flowing around unless they have a control over the thing. Right now, even the most popular cryptocurrency, the Bitcoin, is not trustworthy enough to preserve value, not even as trustworthy as some of the Latin American currencies in their darkest days. It's worse than that. And you've seen the moments in the last. It can't preserve currency. One of the important things about currency, you should be able to trust its ability to preserve your value. You worked hard to earn it. And cryptocurrencies, unchallenged, uncontrolled, cannot do that. At least not. But if you wait for another 3 or 4 years, cryptocurrencies can assume a role where greater trust can be there. Therefore, the world of central banks is looking at creating their own digital currencies. It's very important for nations because if you want to control or manage your economy through monetary policy, how can you do if half the economy is run on cryptocurrency? You just cannot. It's like there was a time when we used to say, oh, it's very difficult to manage India because half the market is operating in black money. So it's a similar situation. So while what the central banks will do in the next few years will alter the future of banking in bigger ways than you can think about. Because after all, banking's bloodline or lifeblood is money. If the shape and feel of that money changes, a lot of assumptions you make in banking will change. So there's a certain role you will have to play as banks. I'm sorry, I'm not lecturing to banks. I'm just saying that banks will have to play a major role if they want to protect themselves. A lot depends on whether RBI will launch wholesale CBDCs for interbank settlements or only retail or also retail CBDCs. If there are retail CBDCs, which ought to be the case, then banks will have to think several times about how they're going to manage retail deposits, because when they get converted from cash into CBDCs, the amount of ability to lend will get reduced, and also the commission earnings from transactions will come down. So as it is, the margin is thin because of competition, but this is not end of the road. If, for instance, commercial banks and senior bankers who are present here sit down together and think about what can be done and work with the central bank on 4 issues, you'll come out winners and the economy will come out as winners. And these 4 issues are questions like, who will store CBDCs? Will it be the central bank? In which case, all of us retail clients will have to have accounts in the central bank. Or will it be, personal accounts in the central bank? That's what will happen if they decide to store it in the central bank. Or will it be in banks? In which case, it will be just like the way you distribute cash, except that instead of cash, you got CBDCs. Or will third-party operators be also allowed to store? If either the central bank keeps it or the third-party operators allowed, it will impact banking significantly. So it's in the interest of banks to actually figure out how can banks play the pivotal role in storing CBDCs. Once again, I want to say this is not fictional. To take it seriously, CBDCs are going to come. Second, how and who will exchange CBDCs? It will be very crucial from the banker's perspective to be the main entity who has the entitlement to exchange CBDCs against fiat currencies. It will be bad for banks if RBI does it exclusively, or if third-party players are also allowed to do it, like in forex business. So unless you anticipate this problem, you're not going to be able to prevent a problem from hitting you. The third is, what will be the means of exchange? Will it be cash or bonds? The least impactful on banks will be only when government bonds are directly interchangeable with CBDCs. A more liberal approach, which is likely to happen in many countries, starting with the Nordic countries, which will enable CBDC purchase by cash, which means cash from bank accounts will go into CBDCs and vice versa. And the most impactful approach would be when there's a direct exchange of banking deposits with CBDC. When I say most impactful, means most adversely impactful. And the fourth is the regulatory entry barriers to get into this business of using CBDTs. Today banks have all the rights, but fintech companies are challenging them. If the RBI or the government erects high enough barriers, which are easy only for banks to jump across, then you're protected. So these 4 things, if you don't take care of, the second half of the 20s are going to be challenging for banks. Who will store CBDCs? How and who will exchange CBDCs? Means of exchange, whether it be cash or bonds, and regulatory barriers. The bad news is that at the very least, CBDC can be seen as impacting CASA and fee earning capacity from transaction. The good news is that many parts of banking will not get hurt. For instance, if you start building a great portfolio of services in corporate banking, what does CBDCs to do with that? You will be what the corporates want. Likewise, if you are able to figure out interesting cross-country, cross-border transactions, then CBDCs are not going to affect you. So the banking will certainly look different in 2030, whether we are a 5 trillion economy or a 10 trillion economy. IMC hopes that through discussions on various topics on banking, which we have had today and which we have every year, it will lead to senior members of the banking fraternity and the finance fraternity to get together to evolve new standards for technology, for processes, for transaction, for charges, for training, and for customer service. When our economy will have paper currencies supplemented with CBDCs. These are going to be interchangeable. The important thing to realize is that it will require a new breed of bankers to emerge from within the banking system who can handle these kind of things. So on the one hand, dinosaurs among banks will get extinct. The nimble and strong banks will rise and become stronger than they were before. That will be good for India, it will be good for Indian companies, and it will be good for the Indian banking system. Thank you for coming today and spending your time with us. And as I said at the outset, please continue this conference in your mind after you leave so that we can resolve some of the most important challenges that India has and which banks can contribute to solving. Thank you very much.
Thank you, sir. As a token of our appreciation and respect, may I request Mr. Raj Nair, President, IMC Chamber of Commerce and Industry, to felicitate our chief guest for the session, Mr. Anand Sinha, former Deputy Governor, Reserve Bank of India, with a memento from IMC for sparing his valuable time for this conference. Thank you, sir. May I now request Mr. S. Sridhar, Chairman, IMC BFSI Committee and former Chairman and Managing Director, Central Bank of India, to summarize the proceedings of this remarkable conference to all present here so that as we conclude, all will be able to carry significant assessment and value of this conference along with you. Over to you, sir.
Honorable Chief Guest, Mr. Anand Sinha, President IMC, Mr. Raj Nair, my colleague on the Banking BFSI Committee, Mr. Dr. Narendra, and friends. We are coming to the end of a tiring day, and I see only some of you who have been brave enough to be attending the whole day. So what I'm going to see is summing up. It will be new to some of you at least, but may be boring to others. I promise to be brief because I don't want to stand between you and the chief guest. So the presentation would be a sort of sketchy and may not capture all that we have discussed in the 4 sessions and the inaugural session, and of course the plenary sessions of Mr. Damodaran and the Chartered Accountant session as well. The first point is that in my presentation, theme presentation, which was followed by release of the theme paper, the knowledge paper, we have slightly outlined how would we actually achieve this $10 trillion economy. I wouldn't call it dream, because dream would give a different connotation, but I would say $10 trillion aspiration. Because the statement that to have a $10 trillion economy by 2030 is an aspirational statement. It is evocative also, because you need to put in so many things. As our chief guest for the inaugural, Honorable Finance Minister of Maharashtra, in his own very powerful speech, motivation. It was a motivational speech in my view, where he motivated all Indians to contribute their might towards achieving this, when he said not even 10 trillion, even 20 trillion could be achieved. So what, in a more technical sense, what needs to be done and what role can banks do? What needs to be done, of course, is heavy investment in heavy investment in terms of the investment rate to GDP has to substantially go up to consistently to over 36% every year for the next 11 years. Infrastructure investments have to be done in excess of 225 trillion in terms of the overall infrastructure and large manufacturing. Productivity increase is a must, need to grow at least 3% every year of the global GDP, and then how can we come back to that glory, where his powerful remarks. He's talked about high concentration of wealth and the need to improve quality of products. Zero import, zero effect, zero defect. That's what some sort of a slogan he gave us that we could do. At a more technical level, perhaps we need to look at a modified financial architecture. Is there a need for bringing back DFIs, because to put investment of this magnitude, can commercial banks handle this type of project financing, which requires a different skill set and a different orientation? And then how do we bring in risk mitigation, because project finance is, as we talked in the next session, is really based on cash flow financing. It is not based on sponsors' personal guarantees or recourse to sponsors as we have in the normal projects. In the session that we had on technical session on project finance, it was observed that investment climate is actually not as rosy in the immediate past, and there are figures that our distinguished panelists mentioned. So they were actually questioning, can the financial system support the kind of investment required to reach this $10 trillion economy by 2030? And there one of their suggestions was that if projects are not amenable to commercial lending, Government of India should step in. This is very similar to what has been mentioned in the inaugural session, that the DFI model, where what was tried out in the years in India, as also in other countries like Japan and in China successfully, can also be looked at. So the speakers felt that the brownfield risk can be probably taken by the corporate bond market, but the greenfield risk will have to be taken by the government. And perhaps after project completion and maybe operation, sustained operation for a year or so, these assets can be monetized and then securitized and then spread amongst various institutional investors or even by banks. But the initial construction risk would be an issue, because banks are also finding it difficult to take that risk. There needs to be a great degree of investment confidence, and various measures need to be taken to attract both domestic and foreign investment in order that there is an immediate impact on GDP. It was also mentioned that, pointed out that there's a strong positive correlation between GDP growth and investment. A 1% increase in investment leads to 0.9% increase in GDP. Regulatory redress for foreign investors to make a smooth exit and get back their money invested was mentioned as a very important point. Because when investors come in, when they enter, they also are thinking about exit. And that is one thing that they would like to be assured, that the legal system, the regulatory system would allow that to happen in due course. There needs to be more predictability in policies, both regulatory and fiscal, and other government policies to attract foreign capital. There's also a mention that as announced in the budget last year, a specialized credit enhancement company or corporation is being planned so that the bonds that are issued by project companies, they would have investment grade rating that would allow more institutional investors to invest in them. We had a very delightful and interesting talk by Mr. Damodaran on corporate governance in banking sector, and he defined corporate governance as doing the right things at the right time for the right reason in the right manner, doing or saying. And he pointed out that compliance and governance are different. Governance means you make the first move, like if you're a chess player, you play the white pieces. And then how do you find ways to improve productivity, increase wealth, and so on, and increase prosperity? But he raised a very valid point, which luckily he's out of the government. I'm also out of the public sector, and our chief guest is also out of the regulator. So we can all ask this question: do owners really want governance? And he said, he gave the answer that in public sector banks, they don't. And he also was castigated the things that today the investigative agencies are doing, and he said they have the benefit of what he called retrospectrograph, which is a hypothetical fictitious instrument which will allow you to know what the investigating agencies will say 20 years later when the files of approval of loans are being examined at that time. So he also pointed out that efficiency is not a function of ownership, and the tripod model of corporate governance, where all three legs, empowerment, incentivization, and accountability, all have to be equal and strong. If one of the legs is broken or not equal, then there are problems. We had an interesting presentation by Crystal where he talked about the near-term outlook. While the other sessions were on the future, this was the near-term outlook, and this was a very positive analysis that he gave. He said the credit growth is picking up, driven mainly by retail lending, and the stock of NPAs is continuing to reduce. We are already seeing in the current year there is a reduction in the ratios, the GNPA ratio, and it will continue to decline. Profitability is making a turnaround, and in fact, public sector banks would, on a combined basis, all make profit next year, that is 1920. But he also pointed out that the capital cushion remains low for public sector banks, and therefore, while they are able to meet the regulatory norms, in order that they are able to lend and meet the capital challenges, the requirements, the fund requirements of corporates and MSMEs, they need to be recapitalized more than what it has been done so far. The IBC has had a salutary impact. Credit discipline has improved, and the balance of power has shifted from the borrower to the creditor for the first time in our country. Digital lending is growing and is expected to increase from 75 billion today, US dollars today, to 1 trillion in 2023. We had an interesting session on cybersecurity where our practitioners from not only banks but also from institutions like NSDL and NPCI, the father of digital banking in our country. Digital payments, not banking. Yeah. And they pointed out that India is a hacker's paradise, and that the second largest incident of cyber attacks in the world as a country is in India. And therefore, and with the phenomenal increase in digital volumes in terms of transactions, data security has become very critical. So the panelists discussed how they are doing it in their respective institutions, and I'm not going into that. But what is important is that there is not only they are looking at protection, they are looking at early detection, because there is really no foolproof method of protecting yourself. And they pointed out incidents where the attacker actually got into the IT infrastructure and lay in wait for 4 months before he chooses. And he needs to do it only once, whereas you have to be on your guard throughout. So detection, response, recovery, all are important. How do you bounce back after an incident response time, cyber drill, bunker disaster recovery site. And probably there's a need for a digital fraud registry, maybe at the central bank. We had a discussion, panel discussion on inclusive banking, what is the way forward, by a panel of speakers from a commercial bank, from a small finance bank, a payment bank, and the microfinance company, which has become a subsidiary of a commercial bank. So they gave their respective views, but all of them were saying that inclusive financing does not mean only lending, because it means management on the liability side as well. It's both liability and credit management. And customers require a mix of asset and liability products to customers, for themselves, to enhance inclusiveness. Technology has brought down the cost of acquisition, but mostly it has gone to improve internal efficiency rather than improving beyond a point, improving very significantly the customer experience. And there were different viewpoints on this. But interestingly, that widening digital literacy is important, all of them agreed, and 75% of new accounts opened in certain bank was digital. We had a rather longish discussion on stress assets, on future outlook. India has the dubious distinction of having probably any major country having the largest volume of stress assets in the world. May not be in terms of ratios, but in terms of actual volumes. And they were, apart from an overall assessment of what needs to be done, they were quite positive on the new RBI circular of June 7th, which replaced the February 12, 2018 circular, which has removed some of the rigidities and without relaxing the credit discipline. Although, as it was pointed out, it may lead to a spate of references to NCLT of even standard cases, but stressed maybe in SMA 1 category or SMA 2 category. So, but I think, and they also expressed the difficulty in being able to approve or able to structure resolution plans along with the professional assistance of the IP, which are on basis of experiences which are extremely customized. Each company has its own peculiar history and own peculiar angularities, and how do you do that, and how do you make it in a structure, and how do you justify it even for future, because nobody should point a finger. Particularly, a lot of freedom has been given to the banks in terms of this circular. It was also pointed out that the Indian stress asset market is getting a lot of attention in the world, and there's a lot of interest from foreign investors, institutional investors, distressed asset funds, and even some of the international banks who are wanting to invest in the Indian market. and particularly the experience of the metal companies in the recent past, whose resolutions have given extraordinarily high returns to these investors, has actually emboldened many other investors to look at our market seriously and to bring in, put in capital for resolution, for implementing resolution plans. There was, of course, a lot of discussion on how can the resolution efficiency be improved. The poor, the inadequate, I won't say poor, the inadequate infrastructure at the NCLT, the limited number of benches, and also the enormous load on the IPs for handling particularly some of the more complicated and complex company issues. And therefore, and also how does the COC upgrade its own quality and in terms of skill sets, because the COC and IP have to go together in order to produce and get a resolution plan approved, which is most effective in preserving enterprise value. So that's it, and
Joined the Reserve Bank of India in July 1976 and rose to become the Deputy Governor in January 2011. As Deputy Governor, he was in charge of regulation of commercial banks, non-banking financial companies, urban cooperative banks, and information technology, among others. He represented India on the G20 Working Group on enhancing sound regulation and strengthening transparency. He was the chairman, governing council of the Institute for Development and Research in Banking Technology, IDRBT, a research and development institution on financial sector technology set up by the RBI. He was also a member on the board of Securities and Exchange Board of India, SEBI. May I now request Mr. Anand Sinha, former Deputy Governor, Reserve Bank of India, our chief guest for the valedictory session, to address the August gathering. Sir, over to you.
Ladies and gentlemen, I have the unenviable task to hold your attention for next half an hour or so at the end of a tiring day. What I would do is, you have heard practitioners basically throughout the day. So I will focus more from a regulatory perspective, both the international aspect of that, as well as some of the issues from our Indian perspective. Now, as far as the theme of the conference is concerned, India, a 10 trillion economy by 2030, role of banks. Now, in an economy, there are many, many stakeholders, and it's not only banks, but banks have to do their job. And banks will certainly have a very, very important role, given the fact that we are a bank-oriented economy. But our banks and in general, the financial system will have to be much stronger and much more resilient than what we are today if we really want to see the Indian economy prospering and reaching that benchmark. I'm sure as Sridhar presented the summary, some very important points were made during deliberations in the technical sessions. But if the banks have to function well, obviously they have to function within the regulatory envelope. And there is a feedback loop. The regulator sets the rules of the game. The banks have to function within that, alter their behavior and strategy to be compliant with the regulatory requirement. And regulation itself, in fact, is fashioned by what is happening, how institutions are behaving. Unfortunately, regulation usually is a reactive game rather than being very proactive by and large, but there are incidents where regulations have been proactive also. One incident which comes to my mind readily is that in 2006, the non-deposit taking NBFCs were brought under proper regulation, which was not the case earlier. And it was not triggered by anything happening in the marketplace, but triggered by the notion of some of us in the Reserve Bank that why should only deposit-taking NBFCs create a problem? The non-deposit-taking NBFCs, which are large enough through their interconnectedness with the system, can create a problem, and that is how we brought this. So this was a very proactive piece of regulation, and maybe it was so much in time that it helped us when the crisis broke out in 2007-8. Now, one of the most important rules is that while any crisis extracts a heavy price, and how much price it extracts depends upon the severity of the crisis, it should never be wasted. Whatever has happened, we have to learn our lessons and prepare ourselves for future. Now, in future, the best that regulation and supervision can do is to minimize or reduce the probability of failures of individual institutions as well as of systemic risk. It can't prevent it altogether. And the second thing which has to happen is that should a crisis happen, should an institution fail, we should be prepared to minimize the impact of this incident. So this is, if you look at from that perspective, that the global financial crisis has extracted a very heavy economic price. In fact, academic studies put the cost of lost output as large as a full year of US GDP. And the effect continues even 10 years after the crisis. And particularly the advanced economies are not really out of it. US has made reasonably good progress, and the most important reason for that is that they were the first to repair their financial system very quickly, unlike other jurisdictions. You know what is happening in Eurozone and Japan. Japan, of course, has been suffering for a long time. So the point is that the crisis extracted a very heavy price and continues to extract even today. But what has been the lessons learned? It is a massive piece of regulation, which is Basel III, which started in 2009 and still continues, even though more or less it has been finished. And the last piece of regulation which has come in December 2017, its implementation would stretch up to 2022. So you can imagine a whole set of new regulations have been built up. And most of you might be aware that we are a member of the Basel Committee on Banking Supervision, as well as on Financial Stability Board. So we contribute as much as others in the formulation of these rules and regulations. And therefore, even from a moral perspective, no matter whatever noise we make, we have to follow these. So the global financial crisis has not been wasted. An enormous amount of work has been done in the regulatory domain. But still there are a couple of remaining issues. One is that in Basel Committee, the quality of research is of a very, very high order when we sit over there and see the papers. But the decisions may not be optimal, may not be number one in terms of scientific concern. The reason is that you have 27 countries sitting on the table, and every country has its own financial system, long history, traditions, so it is not easy to put everybody into a straitjacket, and therefore compromises are made. Now we have more or less, as I said, final set of regulations, but because of the fact that scientifically they may not be number one, it is possible that certain revisions may have to be done, but those would be not very major. The one issue which of course does not come much into public domain is about sovereign risk. The debt crisis in Europe has now given rise to a notion that sovereigns are vulnerable not only on their foreign currency liabilities, but even on domestic liabilities. But this is a highly political issue, so you don't hear much in the public domain, but this is also an area where some work, I believe, is happening. So, do we expect more dose of international regulations which we will have to implement? Not much, as I explained to you. But what Basel Committee is going to do and what the FSB, Financial Stability Board, is going to do is to carry out studies in various countries. They have already been doing it for a few years to check the framing of rules. Have the rules been framed in accordance with the standards laid down? And the approach is name and shame, because their study is put in public domain. And therefore, if you are not following, if you are a laggard, it is out there in public domain, which may hamper the cost of borrowing from international markets if one is materially non-compliant. Will there be a Basel IV? You can bet there would be, but may not be in the short term, may not even be in the medium term, because financial system is very dynamic. It's like a balloon, you press it at one place, it blows up at some other place. So obviously risks are there, and risks may come from some other channels. For example, fintech. Now that is an area which is growing fast. Risks are not fully well understood. So it is possible that something or the other happens. So all I can say is there will be a Basel IV. When, we do not know, but certainly not in the near future. Now let us look at the shadow banking system, and why I want to talk a little bit about shadow banking system is because we see what is happening in India. Of course, shadow banking system is a much larger term, but we usually associate it with NBFCs, and NBFCs, of course, are a very important segment of the financial system as well as of the shadow banking system. Now, as far as there is a qualitative difference, or rather both qualitative and quantitative difference about the shadow banking system in India and abroad. In India, it is still small. For example, the NBFC combined balance sheet is just about 16% of the combined balance sheet of the banking system. Whereas abroad, or if you take in totality, the shadow banking system is larger than the banking system. And it has not shrunk after the crisis. In fact, it continues to grow. And unlike our system where we have structured regulation for NBFCs, the international paradigm of dealing with the shadow banking system is non-structural. So I'll talk a little bit about it. Now there is actually a philosophical underpinning behind why shadow banking system was not regulated. Probably not at all abroad, and even now the approach is more tentative than concrete. The underpinnings, the intellectual underpinnings were that market discipline and self-regulation would provide an effective brake on risk-taking by lightly regulated and unregulated institutions. Only certain types of institutions can create systemic risk, in particular banks, which are at the core of deposit-taking functions and payment systems. Regulation of banks would be adequate to ensure that their lending to entities outside the core would be consistent with systemic stability, which means that the funding by banks of the non-banks, because of the discretion and restraint used by banks, would ensure that the other system would not be in a position to create a systemic risk. Applying regulation to a wider range of non-banks would be too costly, reduce innovation, and potentially increase systemic vulnerabilities by inhibiting the ability of markets to transfer risk. So after the crisis, the Financial Stability Board, unlike the Basel Committee on Banking Supervision, is the standard setter, and it recognizes, in fact, shadow banking is a negative term, but FSB has gone out of the way to say that the shadow banking system is a very valued component of any financial system. What we have to do is to ensure through proper oversight that its negativities are taken care of, and it functions as a robust, healthy complement to the banking system. The technical word they use is market-based finance. Now, what is their approach? Their approach is that you should cast your net wide to ensure that you get all the data of financial activities which is happening all through the economy. And then you have to narrow your focus onto where are the risks, bank-like risks, like maturity transformation, liquidity transformation, and where are the potential for systemic risk to arise. And then you focus on that part of the system. And here also there is no prescribed regulatory framework except to say that this is the menu, and the menu is usually what you use for banks. That this is the menu from which you choose what you want to do at a particular point of time depending upon your perception. FSB conducts an annual monitoring exercise of data collection, aggregation, and analysis to assess the global trends and risks in the shadow banking system, and identifies financial entity types or activities which pose heightened risks, which may call for an assessment of existing regulation by relevant authorities. And India, being a member of FSB, we do participate in this annually. So I'll just give you a feel for numbers in 2 minutes. 2017 monitoring exercise, which was published in March 2018. Of course, there is a subsequent one, but I have the data for the 2018 exercise. So its conclusion is that the shadow banking system shrank somewhat immediately after the financial crisis, but has been rising thereafter. Assets at 48% of the financial system assets are larger than banking system assets at 41%. So the shadow banking system assets are 48%, the banking system assets are 41%. So you can see the enormity and the dimension of the issues abroad, of course, not so much in India because our shadow banking system is much smaller. The shadow banking assets were, now see the trend before the crisis and after the crisis. The shadow banking assets were 153% of GDP of the concerned jurisdictions, that is members of FSB, at end 2016, exceeding the previous high point of 139% of GDP prior to the crisis. So this is what I mentioned, that despite the crisis, despite the havoc that has happened, the shadow banking system continues to be bigger and bigger. Now, if you look at the exercise which has been reported in March 2018, as I mentioned, first you have to collect all the data, then you have to drill down and see where the risks are building up. And in the process, they found that your data shrinks by 72%. That means only on 28% of the assets you can see risks or potential risks, and you have to focus on that. Now, out of all the shadow banking activities, in fact, unlike our country, it is the asset management industry which is the largest. It is about 65% of the shadow banking assets. And the asset management industry has created quite a bit of concern and problem abroad for various reasons. Ultimately, I mean, the crux is, it is about liquid schemes, the question of liquidity and maturity transformation, and also asset management industry taking on high credit risk. Now, all this you find in India too, the problems that we see now with the mutual fund industry. So our approach is more structured as far as NBFCs are concerned compared to what is advocated internationally, and therefore I don't foresee much of those things forcing us to change our regulations or to change our direction. In my view, a structured system is better than a system where you have to keep a very eagle-like watch on what is happening in the system, because it is likely that because of deficiency in data or because to take a correct judgment in this kind of unstructured situation is also difficult, and many things may slip from your hand. So I feel that our system is better. And as far as the asset management industry is concerned, they have come out, the FSB has come out with a set of regulation to deal, mostly to deal with liquid schemes. And one of the recommendations, side pocket, you find being reflected in India also. So having talked a bit about the international regulations which have a direct bearing on what we are going to do, because we are ourselves rule makers or a part of the rule makers, we see that we don't expect many very significant impact on our rule making in the medium term. Now let me now come down to the domestic scene. Let us talk first about banks. Asset quality, you had a session on that. Various steps which have been taken. I will not be going into any detail, just skipping the details and just talking about a couple of things. So various steps have been taken to spruce up the asset quality, which are essentially tightened regulation and supervision, and of course the legislation of IBC, and also the regulatory framework in the form of 12th February and 2018 and 7 June 2019 circulars. The gross NPAs have climbed down from 11.5% in March 2018 to 9.3% in March 2019, which is quite remarkable, reduction of 2%. Provisioning coverage ratio has increased from 48.3% in March 2018 to 60.9% in March 2019. But the progress that we are making, there could be negative surprises coming from various sectors, most notably right now from the NBFC sector. Then some gains that have been made might get a setback. IBC is consistently overshooting the timeline, but that is understandable, and hopefully we will have a tighter set of rules and regulations and timelines will be observed. And then of course, as it has started proving that it is having a very significant effect on the stock of NPAs, it will help the Indian system, the Indian banking system, to control and manage their asset quality. Now, I'd like to talk 2 minutes about the new circular, 7 June. One thing which is remarkable and very good, that except where RBI was forced to go back, that is in terms of making specific or a generalized recommendation for sending cases to IBC because of the Supreme Court judgment, it had to do it. Otherwise, the intent and rigor of the 12th February circular is completely maintained, though there are some practical steps in the circular which will make the life of the bankers easier. But the intent and the rigor is there, and that is where I would want to say one thing. For example, one-day default. Initially when the circular came, there was a lot of euphoria that one-day default has been done away with. Certainly not. One-day default means you have to pay on the due date. There is no question of you're not paying on the due date if you can pay. Of course, there are business difficulties, there are business fluctuations, all that taken for granted. What does it mean is that banks have to ensure that people pay on the due date. If they don't pay, you have to get after them and you have to get your money back. And if you find that this is happening consistently, then you have to look at whether there is any structural weakness, and then you have to go for the corrective action, which will include restructuring or anything else. Now, What I would like to say is that in case we really want to change the credit culture in the country, then the erstwhile 89th day, which means you avoided being NPA by paying on the 89th day or thereabouts, even if you had money to pay. Now that you have got 1 month, it should not get converted into 29th day. I mean, that is the basic thing which I want to say. If a corporate has the wherewithal, it has to pay on due date. If it doesn't have the wherewithal, you have to look into why and take corrective action. So it's a remarkable credit culture change circular, the 12th February followed by 7 June. But my apprehension is that because there is a 1 month here, something there, it should not be taken as a relaxation and a license for taking it easy. Recapitalization, that is another major problem for our banks. Government, as long as one can remember, has always capitalized banks to the best of their ability. But the point is, if we are looking for 2030, 10 trillion economy, we need our banks to be much better capitalized, much more aggressively capitalized, which, given the resource constraints with the government, can become difficult at times. So what is the solution? One is, of course, people talk about privatization. Privatization is not a panacea, in the sense we have seen private sector having its own problems and negativities, just as public sector has a different kind of problem and different kind of negativity. So it is not to say that simply by privatization everything will become very hunky and dory. The point is that regulators have to keep a much more intrusive regulation and supervision, whether it is public sector or whether it is private sector. But overall, privatization affords greater flexibility in operations, and you know the issues with the public sector banks which are there. But given the political economy, it seems to be, it certainly is not an easy task, and certainly not on the radar as far as one knows in the foreseeable future. So the next best thing, according to me, is to ease the burden of capitalization on government, which can happen if we go for a holding company structure. Because the holding company structure, if it's a 1-tier structure, it gives a leverage of 2. That means for 1 rupee invested by government, bank can raise 2 rupees from outside. Today it can raise only 1 rupee. If it's a 2-tier holding company structure, then for 1 rupee given by government, I mean roughly speaking, bank can raise 4 rupees from the market. So this will considerably ease the pressure. Now this holding company concept comes from various strands. There is a 2011 RBI's internal report which talks in terms of financial holding companies, which is that concept. Then in 2013, when we went for new bank licensing, we carried that concept forward, partly for this reason and partly for the reason that we had to create a segregation between non-regulated financial activity of a group and the regulated financial activity of a group, and therefore the concept of a non-operative financial holding company. You will find the same recommendation made in Nayak committee, but that recommendation is from a very limited perspective of creating a distance between government and the banks. It does not talk in terms of the other factors which I mentioned. The prime motive for creating a financial holding company is to de-risk the banks and to free them from the responsibility of managing both capital and oversight and liquidity of its affiliates, that is sister concerns which are operating in financial system, like your asset management, insurance, etc. Whichever way you look at, a financial holding company seems to be very beneficial. So I think it is one of the ways to ease the pressure on government's resources. But simply capitalizing does not help. Along with that has to go the reform process. As far as public sector banks are concerned, if privatization is not possible, there is an excellent blueprint in NAYAC committee recommendations for the reforms, which will certainly help. And all this I am saying from the perspective of making our system strong and be able to deliver goods for the goal that we are talking about in this seminar. Even as these issues we are discussing, there are certain other things which also must be attended to in terms of skills in the banking system, like shoring up risk management, cyber risk management, internal audit and compliance functions. I have felt that banks, and for understandable reasons, put their best officers into business, because after all, business verticals, because after all, they are profit-making organizations, and therefore, they would certainly want the best people to be making profits for them. But that is where we lose out, because internal audit, risk management, and compliance, these are very essential checks and balances on unrestricted risk-taking. So I have always felt, and that is what I would like to repeat over here, that every bank has a notion of who are the high performers, who are going to go far in the hierarchy. Make it a point to put each of them in at least one of these verticals for 3 to 5 years, because that would first of all increase the quality of staff in these verticals, which is very much needed, and also give them the perspective for restraint on the risk taking. And I think having both the perspectives would be very, very beneficial for banks. In case of private banks, problem is largely in corporate governance, and it arises from incentive structure, quality of audits and compliance, and efficient functioning of audit and risk management committees. So here also steps are needed. Compensation has been an instrument of incentive, distorted incentive in the private space, both in India and abroad. And therefore, under FSB, Financial Stability Board guidance, compensation has been streamlined, and RBI did implement the first one. Now they have come out with a second draft guideline, which is to rein in the negative or the downside incentives in compensation as far as private sector is concerned. Let me talk very briefly about infrastructure financing. I think some of the points which Sridhar mentioned, they were very important points. Let me just mention that in India, because of the fiscal constraint, the PPP mode has become or is extremely important. If I give you some data, in the 11th plan, that is 2007 to 2012, investment in infrastructure target was US $500 billion with 30% private investment. The corresponding figures for the 12th plan, 2013 to 17, were US $1 trillion, which is 8.3% of GDP, and 47% of private sector participation. The Union Budget 2018-19 has given a massive push to infrastructure sector, allocating rupees 5.97 lakh crores for the sector. Different studies suggest the required investment in infrastructure at rupees 50 trillion by 2022 and rupees 315 trillion by 2040. So there is a huge need, and in any case, infrastructure is known to spur economic activities because it has linkage with so many industries, and it eases movement of goods and other things, and therefore it spurs the financial activity. It is largely financed by banks in India. Therefore, of course, we have to de-risk, we have to develop corporate bond market and other things. But as it was mentioned earlier, the construction phase is the most risky and uncertain phase. And here, by and large, bond financing does not work for various reasons. If I mention 2 or 3 reasons, the bank lenders serve an important monitoring role for which banks do tend to have the expertise. Of course, in our case, infrastructure financing was done by banks, most of whom did not have any expertise, but that's a different issue. Infrastructure projects require gradual disbursal of funds for which bank loans have sufficient flexibility. And infrastructure projects in this phase are more likely to require debt restructuring due to high execution risk, and banks can quickly negotiate restructuring, whereas bond restructuring is complex and time consuming. So whether the bank finance comes from banks, commercial banks, or whether it comes from development financial institutions, the point is that the execution phase most probably has to live with this kind of finance. Bond finance comes in later on when the project goes on stream. So, so we have to be, because there is a lot of talk of developing corporate bond market as if the corporate bond market will take away all the load of financing infrastructure. I don't think so for the reasons which I mentioned just now. And therefore, is there a need to look at an alternative credit model, credit disbursement model? The point is that we have found the consortium and multiple banking model has not delivered the good because very large number of banks have got involved, most of them without any expertise. And therefore, can we look at a different model, let us say a syndication model, syndication done by only 4 or 5 banks which have the necessary expertise, and then later on it can be sold off. So I won't go into the details of the model, just to present a point that we need to move away from the present model, which has not really given any good results. And of course, we can take this up not for every project, but for large projects, maybe 2,000 crores or more. Development of corporate bond market and credit protection market is an absolute must because of some other reasons also. The bank exposure to groups would now be substantially reduced because of the large exposure rules, where the group exposure could go as high up to 55%, now it comes down to 25%. And also because beyond a threshold, corporates will have to raise at least 50% of resources from non-banking sources as per the RBI guidelines. Otherwise, their cost of borrowing will become higher because of higher risk weight and higher provisioning. So this is broadly about the banking system and a bit of related markets, financial markets. Now let me talk very briefly about NBFCs. As I said, NBFCs are only 16% of the banking sector, but yet we have entities in the NBFC space which are large enough to cause systemic problems. And therefore, the regulation has to be differentiated. It already is, but it has to be more differentiated in terms of dealing with the larger entities which have a larger potential of creating stress in the system if they come under stress. And these fault lines have been over a period of time repaired, tightened more and more, and now again that is being looked into. So the first thing which is being done is on liquidity. A draft guideline has come. When it is finalized, I have only one comment to make, that I think the first bucket needs to be more granular, because the overnight liquidity is the biggest problem. If you have a large negative mismatch in the overnight bucket, particularly for very large NBFCs, you don't have response time with you, much of response time. And that is why that granularity, in my view, should be there, at least for the very large ones. Similarly, the liquidity does not address fully the question of asset liability mismatch, a phenomenon that we are seeing today of short-term borrowing, funding long-term assets. For that, there is another prescription which is known as NSFR, which is being implemented for banks from shortly. So maybe for very large NBFCs, one can think of that. The other point which concerns me is drawing from the case of ILNFS. It was a huge group. It had two regulated entities. One was the top entity, which was a CIC. Another was in between, you had NBFC. But regulating only the top or somewhere in between without having an eye on the entire group does not help, as we found in this case. For example, as per regulation, the leverage ratio allowed to CIC is 2 perhaps, if I remember correctly, but not very different from that. But the group leverage ratio was 14 or 15, it came out. How many subsidiaries they had, that also nobody knew. It started with a figure of 150 or something like that and ended up with 300 something. So this kind of lack of oversight on group functioning is not going to work. And therefore, my personal view would be that for large entities, one has to take a conglomerate view. The other last point which I would make is, I talked about the FSB approach, where they say that that you don't have to focus on legal entities, you have to focus on activities. Now, our regulation and supervision is within the confines of legal entities. Imagine a non-NBFC. An NBFC has a definition. 50% of the assets should be financial, minimum, 50% of the assets should be financial assets, and income from those financial assets should be minimum of 50% of the total income. You can very well be having a very large financial agenda without being an NBFC, so what happens? You are completely out of regulation. Now, your ability to create a problem in financial system does not depend on whether you are an NBFC or not, depends on your activities. So I think this is another area which needs to be looked into. So the road to 10 trillion economy by 2030 is tough and rough, but with determination and resolve, we should be able to achieve it. Thanks for your patience.
Thank you, sir. May I now request Mr. M. Narendra, former Chairman and MD, Indian Overseas Bank, to present the vote of thanks.
Good evening. I think we have already completed our scheduled time, and we are all grateful to Anand Sinha, our former Deputy Governor. What a fantastic paper out of his experience from the financial crisis to Basel III and whether Basel IV required shadow banking, and with the Indian current banking situation and his personal opinion with the regulatory experience. And he has beautifully given, and this whole proposition will be very useful to all the participants who remained for the later part of this program. We had a very good program right from the morning. We should be grateful to our Honorable Minister for Finance, Planning and Forest, Mr. Sudhir Mungatikawar, Government of Maharashtra, in the spirit with which he spoke about the subject. Similarly, we are grateful to M. Damodaran, former Chairman SEBI. These are the two major, other than Anand Sinha Saab. Similarly, of course, we are very grateful to Mr. P.S. Jayakumar, MD and CEO, Bank of Baroda. He is the platinum sponsor for this program. We are all grateful to various other institutions who in different category has sponsored the program. That was a great generosity and support of the cause by the institutions in supporting the program. And we must all give a big clap to S. Sridhar, Chairman of the BFSI committee. And because it is his experience, hard work, and totally worked for more than 3 months on the program. Of course, we were all there, but he is the spirit. And today, I think all of you will watch. There have been a lot of takeaways, as well as the quality of speakers whom we have invited, and all the program went very well. We are also grateful to Raj Nair, President of our IMC chamber with a very great 1 year period of very excellent program conducted, and I think this month end sub period is getting over, and we are going to have Ashish Vaid, President-elect IMC chamber, who gave the welcome address in the morning. We are also grateful to all the speakers who have all come without any fail, and they cover different subjects, and Mr. Sridhar summed up also. The summing up was also very great, and the morning all were talking his presentation of the subject of the 10 trillion economy by 2030. That itself was also great. So I think the entire program had the good contribution by Sridhar Saab. We are also grateful to media, electronic and print media. We are also grateful to IMC staff, all of them. Give a big clap. Some are sitting in the backside, some are in the, everybody has worked very hard, and we are also grateful to the other office bearers, past presidents of the IMC, for all of them who have been giving encouragement for the program. We are also grateful to the other committee members of the banking committee of the BFSI, and all the more we are grateful to the audience. Right from the beginning, the entire hall was full, and even at this moment we have enough. And we have also a lot of students who have come for the program. And finally, we are also grateful to ITC and their hotel and the staff. Thank you very much. Wish you all the best in future endeavors.
Thank you, sirs. I hope all of the participants are carrying enough information and value back home from this conference. Thank you, sirs. So we come to the end of this event. We thank our platinum sponsor, Bank of Baroda, gold sponsors, BNP Venture Capital Limited, DCB Bank, Exim Bank of India, National Securities Depository Limited, NSDL, Union Bank of India, silver sponsors, Brescon and Allied Partners LLP, Federal Bank, India Infrastructure Finance Company Limited, IIFCL, Karnataka Bank, Paytm Payments Bank, Suryodaya Small Finance Bank, Tourism Finance Corporation of India Limited, State Bank of India, our associate sponsors, National Bank for Agriculture and Rural Development NABARD, RBL Bank, and webcast partner Reach Media Global. I would like to request you to kindly fill in the feedback form which is given in your kit. We would love to have your feedback or suggestions, since that's the way that we can keep improving our performance. Kindly hand over the completed forms to my colleagues who are sitting at the registration counter. I, your anchor for today, Selby Nambishan, take your leave and hope you had a great day. Thank you.